If you're a business owner using a SEP IRA because your CPA said it's simple, then missing this video could cost you thousands, and in some cases, tens of thousands of dollars in unnecessary taxes over the next few years. Because here's the truth. SEP IRAs and solo 401ks are both legitimate tax tools, but they do not produce the same tax outcome once your income starts climbing. And the worst part, most business owners don't realize they picked the wrong one until years later, when the opportunity to fix it is already gone. So we're going to answer one question, and one question only. If I'm a business owner making real money, which plan keeps more of it away from the IRS? Before we run numbers, quick context so you know exactly what this is and what it isn't. This is not a retirement explainer. This is not, here's what an IRA is. This is a tax outcome comparison. Two business owners, same income, two different CPAs, two different plans. One owner gets a meaningfully larger tax deduction every single year, legally, for the exact same effort. That's what we're comparing. And we're doing it the way business owners actually make decisions, with numbers at different income levels. Because at low income, the difference feels small. At higher income, the gap starts to hurt. This video is for you if you're self-employed or own a small business. Your income is roughly $150,000 to $400,000. You've heard the terms SEP IRA and solo 401k, and you want the best answer, not the easiest one. And I'm going to assume you're asking the real question business owners actually care about. How do I legally reduce taxes without doing weird stuff? Perfect. Let's run the numbers. Here's the clean difference without the fluff. A SEP IRA is an employer-only plan, meaning there is no employee contribution bucket. The business contributes a percentage of income, and that contribution is deductible. A solo 401k has two levers. One, the employee contribution, you as the employee. Two, the employer contribution, the business. That employer lever exists in both plans, but the employee lever, that's what creates the gap. So if you remember one line from this entire video, remember this. A SEP IRA has one bucket. A solo 401k has two. Now let's put numbers behind those buckets. We're going to look at three income levels. $100,000, $200,000, $300,000. At each level, we'll compare the maximum September IRA contribution, the maximum solo 401k contribution, and what that difference actually means in tax savings. I'll use federal tax brackets as a baseline. Your exact outcome depends on your full return and your state, but the comparison holds. Scenario 1, $100,000 of income. At $100,000, a SEP IRA might get you to roughly $20,000, give or take. A solo 401k at this income might land in the low to mid $20,000. So what happens here? The difference is noticeable, but not life-changing. A few $1,000s in additional deductions. And this is where many business owners stop thinking. They say, SEP is simple. The difference isn't massive. Done. Here's the trap. Most business owners don't stay at $100,000. The plan you choose should match where you're going, not where you were. Scenario 2, $200,000 of income. This is where the gap stops being cute. At $200,000, a SEP IRA might allow around $40,000 in contributions. Now watch the solo 401k. You get the employee contribution, call it roughly $23,000, plus the employer contribution. That often pushes the total to around $55,000 to $60,000, depending on structure. Let's keep it clean. SEP IRA, $40,000. Solo 401k, $60,000. That's a $20,000 difference in tax-deductible contributions. Now translate that into taxes. At a 24% bracket, that's roughly $4,800 saved. At a 32% bracket, that's roughly $6,400 saved every year. Same income, same effort, and different plan. This is why SEP IRAs quietly lose once income rises. They don't have the employee bucket. Solo 400 EMKs do. Scenario 3. $300,000 of income. This is where business owners say, okay, now we're talking real money. At $300,000, a SEP IRA may cap out in the low 60,000s, depending on limits and structure. A solo 401k also has a cap. but it often reaches that cap with more control. Why? Because the employee bucket gets you there faster. Here's what business owners actually feel at this level. With a SEP IRA, you're forced to fund deductions primarily through the employer percentage. That creates two problems. First, cash flow pressure. Second, less flexibility. A solo 401k gives you another lever. That flexibility matters because business income isn't a steady paycheck. So at $300,000, the solo 401k doesn't just potentially give you a larger deduction, it gives you a cleaner deduction strategy. So why do SEP IRAs get recommended so often? Not because they're best, because they're easy. Easy to explain, easy paperwork, fewer moving parts, which makes them the default. But business owners aren't rewarded for simple, they're rewarded for optimal. Here's the line that matters. SEP IRAs are easier to explain, solo 401ks are better to run. Are there cases where a SEP makes sense? Yes. But once you're making real money, you need to know where good enough turns into a silent mistake. Let's hit the common objections quickly. My CPA said solo 401ks are complicated. True. But the real question isn't, is it complicated? It's, is it worth it? You can systemize complexity. You can't systemize a smaller deduction. What if I'm an S Corp? Then the math depends on W-2 wages and plan design. But the principle remains. Solo 401ks usually offer more planning flexibility. I like the SEP because I can decide later. Valid at lower income. But if your income is consistently strong, delaying the right plan costs you compounding deductions. Later is not free. Here's the verdict. Under $100,000, a SEP IRA can be perfectly fine. But once your income consistently moves past $150,000, a solo 401k almost always wins on tax outcome. Because it has two buckets, and that employee bucket is the difference maker. That's where the bigger deductions show up earlier. And that's why choosing the wrong retirement plan is one of the most expensive silent tax mistakes business owners make. Not because it's illegal, not because it's reckless, but because it's invisible. And if you're trying to keep more of what you earn away from the IRS, the plan you choose matters more than most people realize.